Markets are crashing, headlines are scary, and you might be wondering if now is the time to panic. In this video, we're going to be talking about what's going on and what you should be doing right now. So Melissa, like you literally have no idea.
No clue.
For those of you who are like my Aunt Melissa here, let me give you some context of what is happening. Whoa.
My algorithm
I'm looking at it and it's getting bad. Okay. This is Monday, by the way. I'm going to try to work with Chris to get this released tomorrow because it's urgent, or today. Over the past month, the market is down 10%, almost 11%, which is quite a bit. Let me show you the graph and see if that.
Oh, that's bad.
Okay.
That's bad. That's not good.
Right. When you see all the red and you see the steep line going down,
okay,
you don't have to know anything about stocks to be
know that's
like,
not good.
And that's part of the problem with all this is that what happens is there's all of these headlines, there's all this scary stuff. And in some ways it is a little scary. Like there's uncertainty. We don't know what's going on. But what happens is people see this and then get scared. And what happens when we get scared?
Well, then we're going to panic and withdraw our money.
That's one thing. But the other thing is we're just not going to feel secure. So we're not going to spend.
Oh, that's right.
So
and then it makes
there
it
becomes
worse.
this self-fulfilling prophecy of like, we're worried things are going to get bad. So people do behaviors that make things get bad.
Yeah.
So this time in particular, the recent market volatility is due to escalating trade tensions and the uncertainty surrounding the impact on the economy. Essentially, Donald Trump is saying, we're going to put tariffs on everyone, and that's going to affect everyone's business. So everyone's uncertain. And when investors are uncertain, they're like, I don't know if I want my money in the market because we don't know what's going to happen. So they start to pull their money out of the market. That offsets supply and demand, and then the prices go down.
Are you going to tell us what to do? Because
I am.
Okay.
I'm going to tell you what to do. Although I would say this is not financial advice. This is for entertainment only. And I do encourage you to talk to your own advisor, someone that you trust, somebody who's a fiduciary. But yes, we are going to talk about what I would do.
Okay.
Not necessarily what you should do for legal reasons. So first off, it is totally normal for there to be ups and downs in the market. I find that there's something very comforting about knowing when something's normal. Mm-hmm. You know, when you're on an airplane and the pilot gets on and is like, hey, there's going to be some turbulence ahead. There hasn't been turbulence yet. So, you know, like he knows what he's doing.
And he knows it's coming.
He's prepared. And so then when the turbulence hits, it's like, oh, okay. He said. Now, when you're just sitting there and there's been no announcement and then just all of a sudden you drop, you're like, whoa. So maybe that was you. Maybe you didn't know to expect it, but now I'm hopping on and I'm like, excuse me. Please expect some turbulence. There's going to be... Actually, have you noticed they don't call it turbulence?
No, what do they call it?
They say it's going to be a little bumpy. I think that they know people probably have anxiety around the word turbulence. So they try to use more friendly terms. So the market's not crashing.
What is it? What is the word?
It's just a little bumpy. Just to go over just like a big picture overview of what this looks like. Corrections are when the market drops about 10%, and that's going to happen about once a year.
Okay.
So we're within that range of a correction.
I'm already feeling better.
Yeah, that's going to happen once a year. A bear market is when the market drops 20%.
Okay.
And that's going to happen about every 5 years.
Okay.
We're not quite there yet. The last bear market was January of 2022. So we're within range. And then crashes, which are more than 30%, happen rarely, maybe once a decade or two. All of this is normal. That's what we want to say. That's the bottom line. This happens. It's going to happen. If you're a part of the market and you are investing, you just need to buckle up. That's what we do on the airplane. We buckle up. The only person who's going to get hurt in some turbulence is if you jump out the door. You know, you're going to get hurt that way. And jumping off the door is our next point, which is panic selling. So you should not panic sell. The market drops are normal. Long-term investors benefit by staying the course. So you need to stay the course. Stay the course with us. This is what I think is interesting about this, and this is why we got to stay the course. According to JP Morgan, 7 out of the 10 best days in the S&P over the last 20 years happened within 2 weeks of the worst 10 days.
Oh, nice.
So the best days follow the worst days, and missing just the 10 best days, just those 10 days from 2003 to 2023 would have cut your total returns by more than half.
Wow.
So if we get scared and we sell, then the market corrects really quick. We'll see these dips and then shoot back up. And you miss those days, you are going to extremely handicap your overall growth. So we
crazy.
need those best days, and no one knows when those are going to happen. So that's why when we get into the market, we want to be in there for the long term, which is 5+ years. So if we're putting any money in the market, unless we're just planning on gambling with it, which, hey, if you want to do that with a very, very, very small. When I say gamble, I mean less than 5 years investing, and you're going to do individual stocks. I would kind of put that as just kind of fun money, gambling money.
Yeah.
But it is gambling. That's what it is, and you need to recognize it for that. I don't want to call that investing. I definitely don't want to call that my retirement savings. If we're investing, we want to do that for 5+ years. Staying invested through volatile times has historically been the key to long-term growth. So you might be thinking to yourself, Tim, I have excellent investing experience. I wouldn't panic sell. And here's the thing. I look at the channel statistics, which the 100 of you that watch this, most of you are men, right? And so we tend to think we have a lot of confidence.
That's right.
That's one thing men are very good at, is being confident. Research from MIT suggests that men 45 and older who consider themselves to have excellent investment experience are twice as likely to panic sell in a down market.
That is fascinating. I bet they don't consider it panic selling.
They have a good reason for it. Like,
That's exactly. It's logical.
Right?
It's logical. It's not emotional. It's logical.
We'll think we're good. We'll think we're better. We'll think that the normal rules don't apply to us, and we have a reason to make an exception. And if you're twice as likely to do the wrong thing, which means then you're going to miss out on those really good days. So number 2, we want to get some perspective. Pull up a 10 or 20 year chart that shows the market over 10 or 20 years, because that's what we're investing for. 5, 10+ years. We're investing for the long term, and seeing the long-term trends help to reframe the short term. So we'll start at year to date. On the S&P 500, down.
Okay.
Scary, not good. But you go to 1 year.
Okay.
So not good, but not as bad. Now go to 2 years.
Okay, wow.
Now we're up 20%.
Wow.
Now, if we average
Yeah.
that 20% over 2 years, we're up 10%, which is the overall market average in general. 5 years gets us to
I'm feeling even better.
78. And then we go to 10 years, starts to feel a little better.
We're okay.
All right. And then also, look, you see all those other dips. You see those other dips? You see our current dip in perspective of the other
That's right.
dips? So yeah. All right. Number 3, this could be a buying opportunity. If you have some cash on the sidelines, it might be a good time to do something like lump sum your Roth IRA. Lump sum is like, let's say you have $10,000 and you're going to put it in the market. You do that today. That would be lump sum. I'm going to put 10,000. Dollar cost averaging is saying, hey, for the next 10 months, I'm going to put $1,000 into the market. That would be dollar cost averaging, meaning we're going to average. Now it's going to be here. Then in 2 months, it might be here. And I'm going to buy at a higher price point. But then in 3 months, it might be a little bit lower. And so the theory is you're more likely to, you're not likely to overpay, but then you're also not likely to underpay.
Yeah.
Vanguard did a study comparing lump sum investing versus dollar cost averaging using historical market data from the US, the UK, and Australia. The key takeaways are lump sum investing outperformed dollar cost averaging by 2/3 of the time over a 10-year period. Here's the thing. There are more up days than there are down days. So if there's more up days, the sooner you get the money in, the sooner you get to take advantage of those up days.
That makes sense.
Especially when the market is down, then we're more likely to have up days. Again, the best days follow the worst days. And the other thing that I recommend you follow our money milestones. It's kind of like the order in which we recommend building wealth, which means you should have an emergency fund in place. You should have your debts paid off and those sorts of things. So check that out on timgosnell.com. But if you're at the step in the stage where you can be investing in the stock market, you can get some good deals.
Yeah.
Warren Buffett, he has a quote that says, be fearful when others are greedy and greedy when others are fearful.
Nice.
Now, I'm not saying let's be greedy. But what he's saying is let's buy when there's a deal.
Yeah.
And when everyone else is buying, it probably means things are overvalued.
Yeah.
Right. So right now, people are definitely fearful. And so if you haven't, go ahead and get in. Now, we max out in our family our Roth IRAs every year. We're right past the beginning of the year, so we can do that again for 2025. And so today, I plan on going and maxing out both of our Roth IRAs and just going ahead and getting those invested right as soon as I can because things are on sale. All right, number 4 then, stop looking at your account balances. Do you ever look at your account balances?
Never.
Never. Does
Never,
Jared
not
look
once.
at? Yeah.
Yes.
Okay. If you're a nerd like me, and I would love to hear in the comments below, are you a nerd or are you like, I have no idea what I'm doing and I'm trying to figure this out?
Are you a Tim or are you a Melissa?
Which one are you? Are you a Tim or please comment? Like, I really want to get a good feel for this because if you are like me, you're somebody who is checking your account balances multiple times throughout the day sometimes.
You're kidding.
No. And really what I do is because the markets don't update till the markets close. So every day as I'm leaving work, I'm checking the markets, or after dinner, I'm checking the markets to see where we're at. That's fine most of the time when things are like relatively copacetic. But when things are like this, it's going to be like, oh my gosh, I've lost how much money? I mean, it really starts to hurt. And while we know all the other stuff that we've already gone over about the truth about all this, it makes it a lot harder to have the self-control, you know? So it's like, let's just close our eyes.
Yeah.
Let's just take our eyes off of our account balances for a little while. And then on top of that, you might just stop looking at the news too. Like all of it, like any of the things that are going to fuel decisions that you don't want to make right now, which would be selling in my estimation, then we want to stop that. So, you know, maybe look at your account balances once a week or once a month, maybe check out the news once a week, once a month, but like to be plugged in, to have alerts popping up that so-and-so did this, whatever country did this, so-and-so, you know, it's just going to be very stressful. Yeah. There's not a good reason to do it. If we have a plan and we want to stay the course, then we're going to stay the course no matter what's happening in the news. So why even know what's in the news if we're going to stay the course? All right, so that's it. Buckle up. It's going to be fine. If you want to stick around, check out this video right here.